For years, investing was seen as something you did later in life after you'd built a career, bought a home, and had money left over. But not anymore. Today, some of the most active new investors aren't seasoned professionals. They are college graduates, young professionals, and first job earners. They are part of Gen Z and they are entering the markets earlier than any generation before them. Armed with smartphones, investing apps, and endless financial content at their fingertips, they are taking control of their money from day one. But with that opportunity comes a new challenge when everyone online seems to have a hot stock. Can't miss crypto or the next multi-bagger. How do you know what's worth listening to and what's simply a hype? For first-time investors, the biggest risk isn't market volatility. It's making decisions without a plan. So where should you begin your investment journey from? Your first investment, should it be an SIP, an ETF, individual stock? How much should you invest and what habits can help you build wealth over the long term instead of chasing quick gains? We break it all down because your first investment could be the beginning of your financial future, and if you get the fundamentals right, that will definitely last longer for you. And this is the Money Show. I'm with you, Kavita Thapliyal. This is the show where we also answer your portfolio queries. Just in case you want to send across any of your investment details, you can send across your question on the WhatsApp number 865-797-4571. The email ID is themoneyshow@etnow.tv. This is the place where you can get connected with us live and answer, and you can get answers for all your financial goals. All right, but then let's talk about the monetary policy. RBI decided to keep its main interest rate, the repo rate, exactly the same at 5.25%. Now, for you, this means your monthly loan EMIs like home or car loans will not go up, but they will not decrease anytime soon either. Now, if you have floating rate loans, your interest cost will simply remain steady for now. For your investments in the debt market, this decision brings excellent short-term stability because the RBI is holding rates steady instead of cutting them. Fixed deposits, short-term debt funds will continue to offer attractive higher yield for a longer period. Now, the central bank is prioritizing keeping prices stable over rushing to lower your borrowing cost. Now, if you are planning your next financial move, what should be the ideal strategy post the policy announcement? We will discuss more on this, but we're also joined by our colleague Ankur Mishra, who is giving you a synopsis of the MPC outcome today and the commentary of the governor on inflation and growth.
It's a no-change policy from Reserve Bank of India this time, but a lot of takeaways from the commentary of Reserve Bank of India. First and foremost is the growth and inflation dynamics, whereby Reserve Bank of India has now reduce the forecast for inflation by 10 basis points to 5% for FY27. And in that, Reserve Bank of India clearly mentioning that core inflation is something which looks to be aligned, and if you also reduce the precious metal out of it, it remains well within the range. Apart from that, if you talk about the growth, the guidance has been increased a bit by 10 basis points to 6.7%, but importantly, Governor says that even 7% growth is possible for FY27. Apart from that, there has been announcements on the harmonization of interest rates, and Governor did mention that polymer notes may be available by a Q1 of the next financial year. Governor also stated that as far as the upper layer list is concerned, whereby Tata Sons is awaiting whether it will be there in the list or not. The list is expected to be out soon.
All right, so today in the discussion, we'll be talking about what should be your strategy going ahead, because it's not only the debt market. You have to look at it from a portfolio's point of view, and also what should be you be doing for your EMIs and for your monthly installments, which is putting a weight on your pocket as well. We'll be decoding various strategies for conservative investors, especially if you want to lock in money at the current rated fixed deposit, whether it's time to trade in short short-term debt funds, or you should be looking beyond that? And even if we talk about equity, how much of trust should you be placing it on? And looking at the condition in the equity market, where can you get good returns and also a lot of stability? Joining me is Lakshmi Iyer. Lakshmi, hi, good evening and welcome to the show. And all right, so definitely we'll be talking about debt, as you always refer it as Nimbu Pani or a lemonade of a financial portfolio. Not very flashy like equity, but essential, for balance. So let's just start with a very basic question that revolves around navigating the steady rates. Now, with the RBI holding the repo rate steady at 5.25%, retail borrowers are feeling the pinch of sustained high EMIs still. When can the common man realistically expect a relief?
Hi, Kavita. Good evening. So I'd say that there is nothing which has happened in today's policy which will probably give that respite yet to the investor. Largely because if you look at the globe or you look at India, we are really not in a easing interest rate cycle. We are at a, I would say, plateaued interest rate cycle, which means that these rates are here to stay for the long term. And globally, if you draw a trend, it is slightly on an upward cycle, maybe not yet for India. So I think if not rising upward, it's not in any hurry to come downward. So it is going to remain like this. So unfortunately, I don't think there's going to be too much of cheer on that count.
Talk about the commentary on inflation and growth. Much on the expected lines, what would you say? Because it's so far just wait and watch. Is that right?
Absolutely. It is like a long pause. Inflation estimates were slightly revised lower and growth was marginally revised upward. And why not? Because RBI acknowledged that we are seeing a very voracious credit growth in the economy and the banking system is lending full throttle. So that's great news. And economy first quarter has done reasonably well. So I think on both these counts, what we have been observing as a trend versus what the central banker opined on or commented on, I think seems to be pretty much bang on. So no real major surprises on either of these counts.
Now, for risk-averse investors, enjoying 7% plus returns on fixed income right now, how long is this window going to, remain open before rates finally start dropping in or we see any change over there? It's time to make the most of it. What would you say?
No, I think, as I said, Kavita, we are not really in a rate easing cycle in India for sure. And same is to the rest of the globe. So I'd say that these elevated rates are here to stay. You have two ways to participate in this. One is obviously try to lock into these higher fixed returns or participate through debt funds, which are running strategies in the short to medium term, where we like the 3 years and 5 years kind of bucket. So any fund which is kind of positioned in that segment. And most investors like patronizing that kind of category, something which you should find favor with. But as I said, you will get small phases of rates kind of oscillating in a narrow range, marginal easing after today's policy outcome. But I think prolonged reduction in interest rates at the headline or the benchmark level, I don't think that is something which investors should clearly factor in.
You also mentioned, 3 to 5 years time frame. So what is the ideal recipe for the asset allocation in this economic climate?
So I'd say that, if you are looking at money deployments for the next 6 to 12 months, funds which are around the 1 year duration bucket is something which you should definitely look at. Given the kind of flows which we are seeing so far on FCNR deposits, it's roughly around $40 billion. This number can easily double over the next couple of months by the deadline. So I think that will give a good anchor to the short-term yields. So I think that's something, you should definitely look at. And this is not really the time to go fully long on duration. But as I said, playing that short to mid end of the curve is something where investors can find a reasonable, risk-adjusted return in the current market scenario and continue to earn that extra additional return, which probably today their savings bank is not able to offer them.
Lakshmi, before I let you go, can we safely assume that the worst is behind us now? If things will not change, if it's status quo, but it will not worsen, can we say that?
Not really, Kavita. I think today's commentary also spoke about the evolving macro dynamics, especially what is happening in the other parts of the globe. So I would say this is just about buying time for the near term, and the evolving situation will ensure that even the central banker will act pretty deftly rather than waiting policy after policy. For now, I would say there is a near term respite, but we need to ensure, or we need to probably pray to the stars that crude oil prices continue to behave itself, which is such an important ingredient in the shaping of the currency or the CPI in our case.
All right, I think with that, it's a wrap. Thank you so much, Lakshmi, for being on the show today and helping our viewers understand the policy better and also implement the strategies as far as the debt portfolio is concerned. Thank you. And with that, it's time for a short break, but post that, we'll continue answering your portfolio queries. You can note down the WhatsApp number and also the email ID just in case you want to send across your questions even now. You can do that.
Top of the world with Times Network. And you're watching ET Now.
In association with the all-new YONO, power to every Indian.
Dear Bestie, how can I thank you? They say the truest friendships cannot be manufactured. They simply unfold naturally. How true that is for us. Bestie. Love from Bestie Collection. Natural diamond bracelets for you and your bestie.
When the stakes are high and the answers are elusive, there's one voice unafraid to challenge the status quo.
At 8 p.m., I am not here to sugarcoat the truth. I am here to ask the hard questions. Because when others play it safe, I go straight to the heart of the matter. It's not about left or right. It's about what's right for India. It's about holding the powerful accountable.
India Upfront with Pranesh Roy. Weeknights at 8 p.m. only on Times Now. No spin, no compromise, just the truth.
Welcome back. You're watching The Money Show, and it's Women's Wednesday, where we are answering women investor queries. Joining me is now Sameer Shah, founder investor FinServe. Hi Sameer, good evening. Welcome to the show. And we'll start taking our women viewers' questions. This is coming in from Radha. She wants to invest 2 lakh per year in NPS and wants to understand the tax benefit under NPS, and also wants to know the rules around maturity, taxation and partial withdrawals. She also wants to understand if she can continue investing in NPS post the age of 60.
Good evening, Kavita ji. Thank you so much for having me here on your show today. Radha ji, yes, I'll break your question into 4 different parts. First part is you have asked for rebate. Basically, the investment which you make in NPS, you will not get any rebate here, but you will get a tax deduction benefit. So suppose if you are investing 50,000, right, you will get a tax deduction, which means your 50,000 investment this investment will be deducted from your salary, and balance amount will be liable for taxation. So now if you are filing your tax under old regime, in that situation, you will get 30% tax. And if you are falling into 30% tax bracket, in that situation, 50,000 will be deducted, which means yearly you will save 15,600. And if you're filing your return under new tax regime, in this situation, you will not get any deduction. Now, the second part is, do you are willing to continue even after the age of 60? Yes, you can definitely postpone your maturity even after completion, even after 60 years of your age. You can defer your NPS maturity up to 70 years of age. The third question which you have asked for is taxability on the maturity. Say suppose you are at the time of maturity, 60% you can withdraw a lump sum. This entire amount which you withdraw as a lump sum is completely tax-free, and balance 40% you have to invest under annuity plan. The last question was partial withdrawal. Like, you can do a partial withdrawal only after completion of 3 years from of a subscription, and there are certain specific reason or reason to specific reason which has been defined under NPS rule, that withdrawal can be only permitted if the reason is higher education of your child, marriage of your children, buying a house, or any critical illness. Partial withdrawal, you can make up to 25% of your own contribution, and the partial withdrawal is completely tax-free.
Perfect. We still don't have her on the phone line, so I just hope that she's sorted with all the questions, and if at all it's just a retirement goal, she might as well want to diversify. Just out of curiosity, because we're talking about NPS, how has the return been so far, if I just talk about maybe equity-oriented schemes?
So, Kavita ji, if we talk about equity-oriented scheme, I personally invested into NPS, and so far my returns are somewhere close to 13.5% for last 3 years.
All right. What would you recommend, NPS or mutual fund, or both, for retirement?
Say NPS for retirement, I would definitely say that go with NPS. Reason, though you have opted for new tax regime, but this is a human psychology. If money is freely available, in that situation, there are possibility we may redeem for a current requirement, and we may forget our original goal of retirement. Right? That is the first reason. Second, if we talk about mutual fund versus NPS, the expenditure compared to mutual fund, it is very less. So it will definitely have a good impact on your overall return.
Let's take Roopram Nehra's question. And investing 40,000 per month through SIPs, also invested 1 lakh lump sum in ABSL PSU fund, wants to review the portfolio and wants to know if the allocation is right or not. Okay, so Bandhan Small Cap, Geo BlackRock Flexi Cap, Trust Small Cap, White Oak Mid Cap, ABSL PSU fund. Okay, so these are the investments done by her.
So I would definitely say we have reviewed your portfolio, and what we've figured out is 50% of your total investment goes into 2 small cap funds, right? This is a bit aggressive investment philosophy. Here our recommendation is to keep Bandhan small cap fund, and remaining 10,000 she can divert this fund to large cap or any flexi cap, a good flexi cap fund. This will provide a stability to her portfolio. The another thing which we would like to highlight here is, like, she has invested 1 lakh rupees into a thematic fund, right? This generally thematic funds are very cyclical in nature, and there are possibility she may has to wait for longer period of generating good amount of return. Second thing, like, if she is monitoring PSU, particularly PSU sector closely, in that situation she can continue. Otherwise, she can divert this fund to any flexi cap or any diversified fund over a period of time. At least here the risk would be little lesser as compared to a sectorial fund.
All right, let's move on. Let's take Pooja's question. She's from West Bengal. She's 52 years old and planning retirement. Portfolio is almost 36.7 lakhs, investing 20,000 per month, and wants to know if she can reach almost a 2 CR corpus for retirement, and wants to know if she can add another flexi cap funds. She's got a couple of funds. I think you have the details. ICICI large and mid cap, Bandhan small cap, HDFC mid cap, Nippon multi cap, or Akparik flexi cap.
So first, I would say that the portfolio selection is really good. Really good. There is no need to make any immediate changes. Let's talk about her goal. Say the existing portfolio is 36 lakh 70,000. And if it's generate 12% annual return for next 10 years, in that situation, the corpus from current corpus from this will be around 1 crore 14 lakhs, and she is doing 20,000 rupees SIP. If it's generate 12% CAGR return in that situation, the accumulated account from SIP would be around 47 lakh. Both put together, the total corpus would be around 1 crore 60 lakh. Now, there is a gap between the goal of 2 crore versus the actual the collection. So there is a goal. There is a gap of 40 lakh rupees. To achieve this, to bridge this gap, there are two options available. First option is she can increase her SIP. Instead of doing 20,000 rupees SIP, she can increase the amount and take it to 37,000. Or she can, in case if she's not able to, or she's not willing to increase SIP immediately, in that situation, every year she can do a 15% step up of current SIP. In both situations, she is able to achieve her target. The question which she asked is she wanted to add another FlexiCap fund. Our suggestion is that do not add any FlexiCap fund. Reason behind is she already holds one Parag Parikh FlexiCap fund. Apart from that, there is a multi-cap into her portfolio. Even hybrid fund is also there. So adding a FlexiCap fund will not help her to diversify. Even it will have a adverse impact, and the portfolio will be over diversified. So our suggestion is you have a very good FlexiCap fund in your portfolio. Increase allocation there.
But then she's also 52 years old. She can't be invested till 60 in equity, right? She needs to start winding up and reallocate her investments also. How should she do that?
So, Kavita ji, I believe all the investment details, it has not been provided. I believe this is a fraction of her all investment. But your question is really valid. She wanted to invest for next 10 years. After completion of 7 years, gradually she can reduce the exposure from direct equity portfolio and start taking exposure into hybrid fund. That will help her to reduce the total risk from her portfolio.
All right, let's move on. Let's take the other question where once again a portfolio review is needed. Wants to invest 3 lakhs for daughter's education. Investment horizon is almost 10 years and wants to know the right mutual fund strategy.
So our suggestion is that she can classify or maybe break this 3 lakh into invest into two different fund. One is either she can select HDFC or Parag Parikh FlexiCap, where she can invest 1,50,000, and another remaining 1,50,000 she can invest into ICICI Prudential Equity and Debt Fund. This is aggressive hybrid category fund. By investing into aggressive hybrid fund, we are trying to balance our portfolio, because the investment horizon is only 10 years, and the reason behind investment is children's education. So we wanted to play a little safe with the investment. That's why we said we have added aggressive hybrid fund. Second, looking at the market condition is really volatile. So instead of going with lump sum, our suggestion is she can take a STP route. This will and this investment, the entire investment should happen between 6 to 12 months.
All right, let's move on and let's take the last question of the show. This is from Pabitra Ram from Guwahati, retired civil servant and receiving pension, wants to review existing mutual funds portfolio and wants advice on gold and multi-asset and also equity investments. I think you have the details. How would you like to guide her?
So her question is like, no, she wanted to. She has a excess gold fund. Our suggestion is that she can definitely hold the excess gold fund, and the suggestion is like, no, she can cap between 5 to 10% of the total portfolio. And see, the reason behind is like, no, definitely. Generally, we see gold investment as a hedge against investment. So we advise her to continue with the gold investment, but she has to keep a cap of investment. It should not go beyond 10% of her total portfolio. Second question, like no, she wanted to understand is like no SBI multi-cap, right? She has invested into a SBI multi-cap where her investment is 69,000 and the time horizon is only 3 years. Our suggestion is definitely she can continue for next 3 years plan because the multi-asset fund basically this fund is invested into equity, debt, and gold. And during the market volatility, they generally do the rebalancing. So this is an ideal fund for her looking at her age. So she can definitely continue with this fund. No need to make any further changes now. Last is like no, she is doing SIP in Nippon India Multi-Cap Fund as well as I said the Prudential Equity and Debt Fund. I believe the fund selection is really good. There is no need to make any immediate changes, and she can definitely continue with this. But ma'am, as you are retired and we do not have, if you have other source of income and you have other investment, in that situation, this portfolio is looking really good. Stay invested into that. I'm sure whatever goal you have set or wanted to achieve out of this investment, I'm sure you will be able to achieve. Wishing you very all the best.
Sure. So any more clarity, maybe Ms. Pavitra can send across the question again and we'll be happy to help her. But with that, it's a wrap. Thank you so much, Sameer, for taking your time out and for our viewers today. Thank you.
Thank you.
And for our viewers, every Wednesday, we get this Women's Wednesday special where we can help you navigate all your financial decisions, align your investment strategies with your financial goals. You can send across your question on the WhatsApp number that we are flashing on the screen and the email ID. Everything about investment, insurance, tax, credit card, anything about your spending, saving and investment, we have your back.